Ever worry about where the stock market is headed next? You're not alone. Every time the market dips or surges, fear spikes, headlines scream, and suddenly everyone's talking about selling. But here's the thing. Most people panic at exactly the wrong moment. And that's why it's so easy to lose money. The way investors actually behave during market swings often derails retirement plans and disrupts the power of compounding, which will never be recovered. Let's break down why this happens and how you can avoid the trap and make life-changing money while everyone else is throwing their retirement away. Market swings are challenging when you're frequently checking your portfolio, both up and down. One day, your investments rise, and you feel the thrill of winning, making you want to pile more money into the market. The next day, they dip, your stomach drops, and you're suddenly second-guessing your choices. That emotional roller coaster is what drives millions to make the wrong moves. You might know someone who moved everything to cash during the 2020 panic after the market had already dropped 20%. Convinced they were protecting themselves from a market showing no signs of bottoming out, they refreshed their portfolio dozens of times each day. Sent anxious texts to their friends, worried they'd been too slow. But a few weeks later, as they safely held their cash, the market quietly rebounded much faster than anyone expected. It's natural. Humans are wired to react emotionally to extremes. That instinct may have helped our ancestors survive predators or natural disasters, but in investing, it's a liability. Panic choices rarely align with probability, and that disconnect can cost more than any market dip ever could. In saying, "Well, that's because this and that," misses the point entirely. It's easy to look back and explain why the market recovered, but no one saw it coming in real time. The point isn't what caused the rebound. It's that no one can consistently predict what comes next. Markets recover for reasons that only seem obvious after the fact. And by the time everyone feels confident again, the real opportunity has already passed. Fear doesn't only appear during crashes. It strikes when markets climb, too. The S&P 500 reaches new highs, and suddenly everyone's a skeptic. This can't last. Everything is overpriced. It has to crash. Maybe you've said it yourself. People cherry-pick stories from past bubbles, pointing to the dot-com crash or 2008 as proof that the market is doomed to repeat. But that perspective often misses the bigger picture. Look back at 2013. The market had finally returned to pre-2008 levels. So-called experts warned of another bubble. But anyone who stayed out waiting for a crash missed nearly a decade of growth. The S&P 500 nearly tripled over the next 10 years. Even during a normal year, the S&P 500 often reaches 10 or 20 new all-time highs. These highs may feel extreme, but they're just the market doing its job, growing steadily, despite what the headlines say. Over long periods, growth smooths out volatility. From 1990 to 2025, the S&P 500 averaged roughly 12 to 13% annually, including negative years. Remove the down years, and the average jumps to about 19%. So, does it make sense to expect an imminent crash every time the market's up 15 or 20%? Famous investor Peter Lynch pointed out that more money is lost waiting on the sidelines than during recessions themselves. People freeze waiting for the perfect time that never comes. They want certainty, no risk, perfect alignment of conditions. But growth rarely waits. Real progress happens while others hesitate, second guess, or demand proof. Think about starting a business. Waiting for all the stars to align often means never launching. Those who act despite uncertainty often succeed. Investing works the same way. The best opportunities often appear while everyone else is hesitating. The emotional trap isn't only fear. Greed plays an equal role. When markets soar and headlines are optimistic, investors rush in near peaks. When pessimism dominates, they pull back, often at the exact wrong time. Sentiment swings like a pendulum. And those who maintain steadiness through both extremes tend to fare best. Overconfidence is another danger. Maybe you think you can predict market moves, watching charts, following influencers, reading Reddit, or listening to TikTok advice. Yet, markets are unpredictable. They move based on emotion, random shocks, and global events. In 2020, nearly all indicators predicted a long, painful recession. Instead, markets rebounded faster than expected, leaving timing experts behind. The media doesn't help. Fear and greed sell. You'll never see a headline that says markets on track for another average year of steady growth. No one would click it. Instead, headlines scream market mayhem one week and rally of the decade the next because drama gets attention. It's the same on social media. One creator posts a chart proving a crash is coming. Another insists we're entering a new golden age. Both rack up views because uncertainty keeps people watching. No matter where the market is, high, low, or somewhere in between, it's possible to find a data point that supports almost any story you want to tell. Want to be cautious? Highlight a stat about past losses. Want to be optimistic? Point to gains or recovery trends. Both can feel convincing, but both can also mislead. The danger is that cherry-picked data often distorts reality. Headlines, social media, and even well-meaning advisors can focus on a single chart or stat, turning minor swings into crashes or bubbles. It creates a false sense of certainty, making you feel like you can predict the market when in truth, you're only seeing part of the picture. When you focus on the bigger picture instead of the most dramatic numbers, you protect both your portfolio and your peace of mind. And the investors that believe they can time the market, they sell thinking they've reached the peak. And the thing is, they might be correct for a week or two, but the market often keeps climbing while they sit on the sidelines. When a pullback finally occurs, they buy back in, but the discount rarely compensates for gains missed. Timing is brutally difficult. J.P. Morgan found that 7 of the market's 10 best days over the past 20 years occurred within just 2 weeks of the 10 worst days. In 2020, March 12 marked the second worst day of the year, but the very next day produced the second best gain. A 30-year analysis by Wells Fargo shows that missing the 50 best days in the S&P 500 would result in negative returns despite the long-term trend upwards. Missing just a few critical days can erase massive gains. Maybe you know someone who's tried to time the housing market. Many would-be home buyers decide to wait, convinced they'll get a perfect deal if they just hold off. Fear spreads quickly and headlines claim housing unaffordability is at a record high, prices are overheated, and a 50% decline is just around the corner. Others warn that the market is repeating 2008. While prices do fluctuate and dip in certain markets, the broader trend is upward. Homes continue to appreciate over time, and those who wait too long often find themselves facing higher prices and missing opportunities to build equity. Imagine this. It's Monday morning. You're sipping your coffee, checking your phone. A 3% dip flashes across the screen. Your heart races. Your thoughts scatter. You remember a headline about a market crash from last week. You wonder, should I sell? Wait, panic. Meanwhile, your neighbor, who invests automatically and ignores headlines, is at the gym, talking with friends, reading a book, and focusing on earning money. A month later, the market is up and your neighbor's portfolio grows completely stress-free. Fortunately, you didn't end up selling, so you lost nothing permanently, but you did lose clarity, time, and peace of mind. That matters just as much as money. Even if you could predict peaks and rebounds perfectly, the emotional toll would be enormous. Constantly refreshing your portfolio, obsessing over Fed announcements, and every economic report is mentally draining. Reacting to every headline can disrupt sleep, strain relationships with your family, and result in overall worse performance. Emotional stability is as crucial as financial discipline. It allows you to act rationally instead of reactively. Dollar-cost averaging, consistent contributions, ignoring the media, boring, repetitive habits compound powerfully. Turning off the news, checking once a week, automating contributions. These are invisible victories. Compare that to chasing perfect timing. It's exhausting, emotionally draining, and rarely pays off. The most effective strategies are boring but consistent. History reinforces this. In 1987, markets dropped over 20% in a single day but recovered quickly. Those who panicked missed the rebound. The dot-com crash, early tech investors who sold out missed years of recovery in diversified indexes. The 2008 financial crisis. Those who stayed invested over the following decade reaped massive gains. The 2020 pandemic markets rebounded faster than most expected. Calm investors prospered, and those are only the most notable declines. There are plenty of other smaller drops that many people have already forgotten, like the dips in 2018 and 2022, for example. Investing is about improving your life, not making it harder. If checking your portfolio constantly, trying to time every move, and stressing over every market swing leaves you anxious and sleepless, it begs the question, what's the point of investing at all? It's supposed to provide growth and security, not turn your financial plan into a full-time job. On the other hand, staying calm, checking less often, and trusting your plan is what actually gives you freedom. You can go on vacation without your stomach in knots, be fully present with your family, and enjoy your hobbies without guilt. Because when you stop obsessing over every market move and just let your portfolio do what it's built to do, you start to realize something powerful. You're getting wealthier without even trying. Your money keeps working while you're asleep, while you're out to dinner, and you come home from vacation wealthier than when you left. So, what should you do for best results? Focus on the long term, not just a few months at a time, but 5 to 10 years. Markets trend upwards over decades. Ignore headlines. They're designed to provoke, not guide. Stick to a plan. Pre-decide your actions. Watch emotions. Fear and overconfidence signal danger. Automate contributions. Dollar cost averaging works across all market conditions. Lastly, stay humble. And remember, you're better off staying invested. When people think about emotional investing, their minds usually jump straight to market crashes and panic selling. But that's only part of the story. Just as many losses happen during good times when investors convince themselves the market's too high and pull out only to watch it double or triple afterwards. Learn from the lessons of others and don't make the same mistakes yourself.